Now we are starting this particular webinar. As you all know, the webinar will be on advanced option strategy and how a trader can trade and make money in the option strategies. So first, before beginning the whole webinar, I would also like to share that I will be taking the webinar both in Hindi and English. So I'll try to speak most in Hindi because in our last webinar this was the feedback which was given to me. तो हम इस वेबिनार को स्टार्ट करते हैं। इस वेबिनार का बेसिक ऑब्जेक्टिव यही रहेगा कि ऑप्शन स्ट्रैटेजी में ट्रेडर्स कैसे ट्रेड करें। आई होप मेरी वॉइस एकदम क्लियर है। इफ माय वॉइस इज क्लियर, अगर आपको वॉइस क्लियर आ रही है तो आप प्लीज यस टाइप करके चैट ऑप्शन में भेज सकते हैं। Okay, and I also guess that some of the attendees are not too well versed with Hindi, so I'll be trying to mix it with Hindi and English both, and as much as possible to make you guys understand the whole webinar concept. So let us begin the webinar. So these are the topics which we'll be covering. So basically, first we'll be sharing what derivative is for all those clients who are new to the derivative market, maybe those clients who must be trading in the cash market or maybe commodity market. So I'll give just a brief intro of what derivative is, how the derivative markets are done. Then I'll be introducing what options is. So basically, we have been getting queries from so many clients that is options really useful to them? Does option helps them to minimize the risk? So I'll be taking you through how you can trade in options, what exactly the options are, and how you can make money in different strategies. Then we'll be taking up some derivative intelligence and application, how derivative markets could be deeply analyzed. Then some do's and don'ts in the derivative market. Now I guess you must be seeing a image in front of your screen. The image simply identifies or tells what derivative is. So derivative is nothing but a betting or speculation on an underlying asset. So that underlying asset could be either the forex, it could be a spot, it could be on commodity, it could be your shares. So anything on which you play a bet or you speculate on something is known as a derivative contract. So options, so as the name suggests, options give the buyer the right but not the obligation to exercise. So insurance could also be understood as a form of option. So call option is simply the right for the buyer of that option. So let's say I am bullish in the markets. So I buy a call option. So call option is a bet on the rising of market. So let's say I'm bullish on the markets, I'll buy call option. If I'm bearish on the market, I'll buy put option. To make it very simple, this is how you can understand the option is. There is also a very common myth amongst the traders that selling a put and buying a call both are same. So virtually they are not the same. We'll be understanding in the later part of the options how selling and buying and options differ from each other. So option mechanism. So premium price is like a price of a stock. So premium price is the price which you pay to buy a particular option contract. So it consists of intrinsic value and time value. So premium consists of intrinsic value and time value. Intrinsic value of an option is the price which will be received by an option buyer if he exercises his option today. So let's say market is trading at, Nifty is at, let's say 7,000, and you buy a 6,900 call at 150 rupees. So let's say market expired today. What you have done is you have bought a 1,600 call, which means that you expect the market will be moving above 6,900. So let's say market expires today at 7,000 level. So what will happen is at 7,000 you will be making 100 rupees profit on that particular option because you have won that particular bet by 100 rupees. So this is what an intrinsic value is. Now time value of an option. Now time value of an option is the premium component which is other than the intrinsic value. It is also known as the risk premium. So in the same example, if the market is at 7,000 and you bought 6,900 call at 150 rupees. So 100 would be your intrinsic value and 50 would be what your time value. So time value is the amount which is the risk premium which the seller charges from the option buyer. So how to calculate the intrinsic value? In case of call, spot minus strike. In case of put, strike minus spot. So let's say spot is at 5,000 and you have bought a 4,900 call at 150 rupees. Same example, 100 rupees would be intrinsic and 50 would be the time value. Option style and moneyness. So options on the basis of their expiry can be divided into European or American styles. So European style options are those which can only be exercised on the expiry day, and American options are those which can exercise on or before the expiry date. So moneyness of an option can also be described when an option is exercised. So in the money option. So in the money option is an option which gives a positive payout to the option buyer when it exercises that particular option. So for example, call when spot is greater than strike, it is known as in the money, and put when spot is less than strike. At the money, when spot and strike both are equal. So let's say you bought a 7,000 call and market again is going at 7,000. OTM, which is out of the money option. So an option which will give a negative payout to the buyer if he exercises it today. So in call, if spot is less than strike, it is an OTM, and for put, if spot is greater than strike, it is known as an OTM option. Some features of options. So it gives the right but not the obligation to the buyer. It has the same contract cycle and underlying asset as in future contract. Limited risk and unlimited profit to the option buyer. So when you buy a particular option, you have limited risk and unlimited profit potential. We'll be seeing in the later part of the webinar how the risk is limited and profit is unlimited when you buy an option. So there are different strike prices available in a contract cycle, and it can be used in both bullish, bearish, volatile or stable kind of market. So this is the beauty of an option contract, that with options you can use the options in all kind of markets, whether it be bullish, bearish, volatile or stable market. So this is the difference between buying and selling an option. So as I was discussing earlier, that also I like to share that I am getting some queries on the options and trading. I'll simply request that you please note down those queries, and we'll be taking all the queries at the end of the webinar session. So please note down those queries, because I'll not be able to answer those queries in between of the webinar. Okay. So buying an option is when you pay the premium and get the option right from the option seller. So the risk is limited. For option seller, the risk is potentially unlimited. Return, it is potentially unlimited for option buying, and it is limited for when you sell the option. So when you sell an option, the amount of premium which you receive when you sell an option is the maximum amount of profit you will be making out of that particular option contract. So advantage, initial payment when you buy an option is premium per share into lot size, which is comparatively lower. When you sell an option, the amount which you have to pay is the margin money, which is normally equal to that of the future contract. When you buy an option, the advantage is that you have limited risk. When you sell an option, the advantage is that the maximum profit which you will be having, you get it on the day one. So the objective of telling you guys the difference between buying and selling is that when you go out and trade in the options, you will know that what is your risk, what is your return parity, and how much money you will be making out of that particular option contract. So effect of time decay. So as the time goes on decaying, the effect is negative when you are buying an option, and the effect is positive when you are selling a particular option contract. Okay. So after this brief on how the option contract is, how the options trading takes place, let me move you all guys towards the practical implementation of how the options can be traded. So let me talk about that. Let us understand about today's market. So today's market, the market was, it opened with a positive gap, obviously because there was a Fed decision out there, and the market gave a thumbs up to that decision. And then because the dollar was down and it was a normal scenario that whenever the dollar is down, the rupee gains and the buying in the Nifty emerges. So that was the only reason why the markets opened in the positive. Now, how you would have used option maybe yesterday was, so let's say you knew yesterday, if you guys remember, the market Nifty spot touched somewhere around 7405, and if we compare it with today's market, 7550, 7560 levels, it was almost 150 rupees profit to the option buyer. Now how, let me explain it to you. Now let's say yesterday, if a client, 90% of them knew that Fed would not increase the rate and the dollar would fall from here. Now speculating that, let's say I bought a 7500 call yesterday somewhere at around 70-80 rupees or so. Today I'm not clear how much the price of the option increased, but I'm just guessing it would have touched around 170-180 rupees. So assuming that someone would have bought Nifty 7400 call yesterday paying 70-80 rupees, and assuming the I'm just taking the lot size as 50 for the simplest of calculation. So 3500 was the amount which he or she would have paid, comparing it with 70 rupees. So that 3500 rupees would have turned to somewhere around 7000 to 8000 rupees today. So in one day, just by taking the advantage of the option contract, you have doubled your money. So the point which I want to make out here is that with the options, risk is limited. So when you are buying that particular call option at 3500 rupees, the maximum risk which you have is 3500 rupees only. And that is not that it will be zero. You could put a stop loss somewhere at, if you bought a call at 70 rupees, you could have put a stop loss at 50 or 55 odd rupees, or maybe on the spot side 73.80, 73.50 kind of rupees kind of level. So the point which I want to make is that if you guys trade in future contract, the same leverage, the same information, the same trend could be effectively used while trading in the options market also. So coming back to our example, so let's say you are highly to mildly bullish in the markets. What you do is you buy an ATM or OTM call in the market. So you go out, buy an OTM or ATM call. So let's say I'm assuming the Nifty is at 7000. You have bought a 7100 call somewhere at 100 bucks. You're paying 100 rupees for that particular option. So I'm assuming 50 as a lot size in all my examples. So on day one, the amount which you have paid was 100 rupees. So if the market expires at the same level which you have bought the option, you would be making a loss of 100 rupees per share. So on day one, when you buy a particular option, your maximum loss would be 100. As the market moves up, so market moves to 7200, then your profit you'll be more or less on the BEP, break even point. When the market moves to 7201, the basic assumption which I am taking out here is that you do not square off the option in the real market, but you wait till the expiry and let the market expire and then you exercise your option. So this is the basic example which I am taking just for the purpose of making you guys clear on the options market. So when the market goes to 7201 levels, you make a profit, your profit starts. As the market moves up, as you see that the market, if the markets move at somewhere around 7800, your profit is 600 rupees. So it is potentially unlimited. As the market moves up, when you buy a call option, your profit is potentially unlimited. As the market moves down, as you can see, when the market moves from 7100 to 6500, the maximum loss which you are making is 100 rupees. So if the market moves to 6000 also, the maximum loss which you will be making out here is 100 rupees per stock, per share. So the next strategy which we are taking up is short put strategy. So this strategy is basically useful when you think that the market is highly bullish, there is no or potentially very low downside risk. So let's say when the markets were at somewhere around 7000, 7200 after the budget time, and you are very sure that the market has now made the bottom, which was somewhere around 69 and 60, 6800 odd levels. So that was the strategy which you would have used at that position, at that point in time. So your trade would be you sell an ATM or an OTM option. Risk would be unlimited in a bearish market. So when the market moves down, the risk would be unlimited. The return would be limited in a bullish market. So let's say Nifty spot is at 7000 and you have sold 6700 Nifty put at 30 rupees. So as the market moves up, as you can see, as the market is moving up, your maximum profit per share is limited to only 30 rupees. But as the market moves down, your maximum loss keeps on increasing. So in this strategy, you should implement this strategy only and if you feel that the market is highly bearish, highly bullish, and the market has no or limited downside potential. Now this is the covered call strategy. So this strategy could be used in mildly or ranged bullish. So let's say at 7200 you think that the market has the maximum upside of 7600 in this particular expiry and the maximum downside of 7200. So what you do is you take the advantage, or let's say you take the advantage of the market movement. So for example, I have taken that the market is at 7200 and the maximum upside you think is 7300. So what you have done is you have bought a 7200 future and you have sold a 7300 call at 75 rupees. Now let us see the payoff for this particular strategy. So as the market moves up, your profit would be limited and the maximum profit in this particular strategy would be 175 rupees, which would happen at 7300, which is the upper leg of this strategy. So you have bought the Nifty future at 7200 and you have sold a 7300 call in the options market. So your maximum profit in this particular strategy would be 175, which would happen at 7300. So if the market, it will not matter when the market moves to 7500, 7600, your maximum profit would be limited to 175 rupees. But if the market goes down, the future contract which you have bought will give you a loss, as you can see in this particular strategy. As the market is moving down, your future contract is giving you a loss, but the call which you have sold will give you a limited profit of 75 rupees. So this strategy should only be used when you are highly clear and highly sure that the market has very low downside potential, like the current market condition. So bull call spread. This is the next strategy which we will be discussing. So bull call spread, it is the ranged bullish market. There will be a probable downside risk. The trade which you will be doing is you will be buying an ATM call and selling an OTM call option. Risk is limited to the net premium which the trader has to pay. The return is limited, but it is positive in the bullish market. Now what you do out here is, let's say trading, the spot is at 7,000. You bought a 7,000 call somewhere at 100 and you have sold a 7,200 call somewhere at around 50 rupees. So as you can see, when the market moves up, the call which you have bought, you have paid 100 rupees, will give you unlimited profit. As you can see out here, the call which you have bought is giving you virtually unlimited profit, but the call which you have sold will give you loss as the market moves up. But your maximum profit would be 150 rupees if the market moves up, and your maximum loss would be 50 rupees. So out here it is a 1:3 kind of strategy in this particular example. When your maximum loss is limited and your maximum profit is also limited. So what you are doing, you are taking the advantage of a particular range which is being made in the markets. Now after this we will be moving towards the bearish side of the strategy. So first strategy is long put. When you are bearish in the market, what you do is you buy an OTM or an ATM put. So for example, Nifty is trading at 7,000, you have bought a 6,800 put at 50 rupees. Now as you can see, as the market moves down from here, your profit is potentially unlimited. So this kind of strategy could be used when you see that the market is at the top and you are bearish about the market and do not want to take huge risk. So you don't want to buy or sell, maybe sell a future contract. So what you do is, this is an alibi of selling a future contract. So instead of selling a future contract, what you do is you buy a put option. So when you buy a put option, your investment would be less and your profit potential would be much higher than when you buy a future contract. Now short call. Now this is again a aggressive kind of strategy where you think that the markets will go down and you sell a call option. So let's say out here you think that the market will go down and you sell a 7,800 call option in the markets. So let's say Nifty spot is trading at 7,000 and you have sold a 7,300 Nifty call which is at 50 rupees. As you can see that as the Nifty spot moves up, your loss would increase, but as the Nifty spot is down, you will make a limited profit, which is maximum profit is limited to 50 rupees. Now let us move to the next strategy, which is the covered put strategy, which is again the bearish side of the market. So out here the market is bearish, but it is in a particular range. So what you will do is you sell a future contract and you sell an OTM put also. So the risk is unlimited when the market rise, but the profit is limited in a rising market. So what you have done is you have sold a future contract at 7,200 and again he has sold a 6800 put at 50 rupees. So as you can see that as the market moves down, your maximum profit is 450 rupees, which you are getting out of the markets. But if the market moves up, your maximum loss increases and it is virtually unlimited. So if the market moves up, your loss is unlimited, but if the market moves down, so let's say we take a current example. So let's say you sold a Nifty future at 7500 and you have again sold a 7200 put or 7000 put, thinking that the downside of the market is limited to 7000. So this is how you can implement and make money in the current market. So bear put spread. Again, this is a capped bearish kind of market with upside risk is potential. And what you do is you buy an ATM put and you sell an OTM put. Risk is limited, profit is again limited. So what you are doing is you are buying a put option, which is an ATM kind of put option. You are selling an OTM kind of put option. You have bought a 7200 put and you have sold a 7000 put at 50 rupees. So as you can see, when the markets move down, your maximum profit out of this particular strategy is 150 rupees. That is the maximum profit, and your maximum loss again is 50 rupees. So this strategy could be used when you think that the market is moving down, but market is capped on the downside. Now we are moving towards the end of the webinar, and I'll be taking some derivative analytics with you guys. So first, open interest. So there is a huge confusion out there between traders, investors, and many participants in the markets that what exactly is an open interest. So open interest is nothing but the total number of outstanding positions which are yet to be squared off as of that moment. So it is updated intraday, it is updated real time. So let's say you have bought one lot of Nifty, which will increase the Nifty open interest by one lot. When you square off that particular lot, the open interest will again be zero on your end. Put call ratio is the ratio between the volume or open interest of put divided by the call series. Rollover, when you roll your series, so let's say you are bullish, you have bought a Nifty contract in the Nifty option in this particular contract. What you do is you sell at the expiry, you sell this contract and again buy the same side in the next contract. So it is known as rolling over. Okay. So PCR is basically, it represent that how many puts are being written or puts are being traded as compared to call. So let's say if PCR is, let's say 1.25, which means that 125, let's say I'm talking about 7,500 strike price option and the PCR is 1.25. So there are 125 puts open interest as compared to the 100 call open interest. If the market is going down and the PCR increases, which means that more and more traders are selling the puts, the maximum PCR which normally the market has is in the range of 1.5 to 1.75. Above 1.75, we normally call the PCR to be at the extreme level. So whenever the PCR moves above 1.75, there is a huge reversal in the market which will take place, and this is just an assumption on the basis of PCR volumes. So PCR normally represents how many put are being written or are being traded as compared to the call in the same strike price. So India Volatility Index, which is known as India VIX. So you guys must be seeing that this is the volatility index is somewhere at around 22% or 25% or 18%. and the volatility index is increasing or decreasing. So volatility index shows that how much volatility you can expect in the Nifty for the coming 1 month. So let's say if the volatility index is at 20%, which means in the next month, according to the statistical calculation, the tool says that there is a probability of 20% volatility in the Nifty. As the volatility decreases, the option premium decreases. Market wide limit. So market wide limit is the 30 times of the average daily traded in the cash market or 20% of the non-promoter holding. So this is the maximum open interest a trader can make in a particular contract. Banning of security. So you guys must be hearing that X particular strategy is being banned, or this strategy, this particular future contract is being banned from trading. So when the market wide position limit reaches 95% of the market wide limit, so the open interest, when the open interest reaches 95% of the market wide position limit, the contract is being banned for the trading until the OI reaches till 80% of the MWPL limit. So how the open interest probably predicts the future probable trend. So if the price is moving up and open interest also increases, which simply says that the trend could be bullish because more and more participants are entering the contract when the contract is being moved up. On the other side, if the price moves up and the open interest starts decreasing, which simply means that as the prices are moving up, the traders are booking profit or there is a reversal in the market. If the price moves down and the open interest increases, which simply means that the market is bearish, because as the market keeps on moving down, more and more traders are taking the bearish position in the markets. On the other side, if the price moves down and open increase trend is again down, it is again the profit booking. So when the price of contract is moving down and OI is also decreasing, which simply means that with the prices falling down, the traders are squaring off that positions, which means that the traders are anticipating that the market would not be down for a longer time. Let us square off and get whatever profit is on the table. So in this example, what I have done is I have taken a return on capital between future versus option. So let's say there are two traders. Nifty spot is at 5,000. So trader A buys Nifty spot, Nifty future contract at 5010. So first trader has bought a Nifty future at 5010. He has paid a margin amount of somewhere around 25,000 rupees. Another trader, he has bought a Nifty 5100 call by paying a premium of 100 rupees. So one trader has bought a future contract, another trader has bought a option contract, which is call option. So we are assuming that the Nifty expires at 5500. So trader A would be making a profit of 24,500, which is almost 97% or 100% of his capital. He had invested 25,000 rupees and he had made a profit of around 25,000 rupees. So 100% return on capital. But on the other side, the trader B, which had invested 15,000 rupees, has made a profit of somewhere around, who has invested 5,000 rupees, sorry, and made a profit of 15,000, which is the profit of around 300%. So as you can see, the option trader has made 3 times profit, but the future contract trader had made only 1 time of the profit. So this was the whole objective of taking the option webinar, that you guys know that with the same capital which you are investing in the future contract, you can trade in the option contract, make much higher return on capital with lower risk capacity. Some do's and don'ts. So first we will be understanding the do's. You should clearly understand the trade payoffs before you are trading in the market. Clearly understand the margins which are required by the brokerage which is being charged. Check all the expiry contracts of the instrument before trading in the future contract. So let's say you're trading in ACC future. So you should check the price of all the contracts just to get a feeler of how much premium or discount the contract is being traded. The options which you are trading should be highly liquid. You should do a trend analysis. In the last webinar which we have done on technical analysis, and just to share, we will be taking much more webinars on technical analysis in our future webinar series. So we have shared that how you can do a trend analysis using the technical analysis tools. Now some don'ts in the derivative market. Never over leverage when you're trading in future. Be very careful when you're selling an option contract. Always put stop loss. Never avoid putting in stop loss in the derivative contract. If you are not fully aware of derivative market, avoid trading in the segment. Do not average only because you have the money to trade. Don't hesitate to cut your loss if you are done a wrong trade. So this is the major problem which the traders have. They have an ego problem. So it's an ego that you have bought a contract. Why to exit in a loss? But if you are a trader, you have limited capital. Ideal strategy is book your stop loss and exit from that market. So with this, we are at the end of the webinar, and if you have any queries, feel free to ask your queries from us. You can ask your queries through the chat option. Okay, so there is in fact a query that they want the recorded webinar. So you'll get the recorded webinar on the mail maybe by tomorrow. You will see that webinar on the YouTube channel of SAS Online. Okay, so the first question is, what is the reason of VIX, which is volatility index in the market? So let's say if you guys know that currently the option contract in VIX is also being traded on the markets. So the use of volatility index in the market is it will show you how much volatility and how much risk on your capital is. So as high the volatility, so much would be the risk on your capital. Okay, it's a fantastic question by a trader. Although it's a very simple question, but let me answer it. How put call ratio is more than 1? Because every seller there is a buyer. So I'm not talking about the put call, the call to call ratio. I'm talking about the put call ratio. So for example, 7500, you can go to the NSE India website and you can take a live feeler of how the PCR works. So I'm talking about 7500 strike price option. So you could also you'd also agree that on the 7500 call option, the volume on the call side could be 100, but more and more guys are trading in the put option. So put volume could be 125 and call option could be 100. So this is how the volumes of put and call are different. I hope I have answered your query. Okay, so there are many stocks in F&O market. How can we choose which option contract to trade? Very good question. In fact, for a newbie, and I guess you are a newbie in the derivative market. So first, you should stick to the Nifty contracts. So Nifty has 50 contracts. Stick to those contracts. Do not move if you are a new trader. Do not move outside those 50 contracts. Trade in the contracts which are either gaining or losing on the Nifty side. So let's say if you talk about today's market, the cement stocks were gaining. So stick with the stocks which are gaining or losing in the market. So the next question. What is the correlation between VIX and Nifty? So basically, there is no huge correlation between VIX and Nifty, but whenever the VIX tend to fall, the Nifty tend to rise, but you cannot always set this particular kind of correlation. Okay, so the next question is, some of the scripts have no buyer, no seller. Ideally, you should avoid those scripts. Okay, so again a question maybe from a new trader, that what is the chance of option buyer to make money, when to exit a profitable trade and when to keep a stop loss? Very good, very fundamental question, but very important question. That now here your technical analysis will help you. So let's say my technical analysis says that, let's say for example, if I talk about Ambuja Cement, or let's say I talk about ACC. So Ambuja Cement, let's say I bought a call of 220 out there in the market, or let's say I bought a call of 210 in Ambuja Cement, which was rising in today's market. So I bought a call at 3 rupees. My stop loss is at the spot. I'll be keeping 210 level in the spot as my stop loss, or if I'm talking about option, I'll be keeping 2 rupees as my stop loss and 5 rupees as my target. So this target and stop loss would come only after your technical analysis. So again, there is a question, some advanced question, that how calendar arbitrage in option or option arbitrage strategy work. So calendar arbitrage is normally when you trade in the same, let's say I'm talking about Nifty 7500 call, and I am buying, let's say this current month call 7500 call, I'm selling next month 7500 call, and then I'm again buying the next to next month 7500 call. So this is how the calendar spread works. So the whole funda of the calendar spread is the volatility. As high the volatility is, as profitable your calendar spread would be. Okay, so where you can check the Nifty call and put numbers, you can see the call and put codes at your trading terminal also in nseindia.com. When you go to nseindia.com, go to live markets and option chain, or just Google NSE India option chain, and you'll see the option chain of different contracts. Okay, so if the open interest is high of say a particular level, for example 7600, then do we consider that future want to go beyond that point? So let's say 7600 open interest is being building up. So can we say that the markets will move beyond that? Ideally, only on the basis of open interest you cannot say that the market will move in a particular direction. You will be needing the help of technical analysis also to predict the direction. So is high volatility good for the market? It depends on which side of market you are sitting. So should we buy an ATM or OTM contract, or is in the money contract is also good? So it depends on the kind of strategy which you are using. Next question is, which is the best technique to analyze? As we have discussed in our last webinar, a combination of maybe moving average and RSI could be a good strategy to start with. So there is a question on short triangle, although we have not taken that particular strategy this time. We'll be taking in the next webinar series. So short triangle is not always good, but maybe in the times when you see that the markets are near some news event or maybe some big event in the markets. Okay, so another question, maybe suggestion, why you not give recommendation for the clients? So we'll think on it and we'll then get back to you. Next question is it bit difficult to judge trend bullish or bearish? So which pair should be adopted? So although if you think that the market is bullish and you know that which range of or maybe which side of the market the markets will go, then you can put up a strategy. Okay, so the trader wants to know the YouTube channel. You can simply go to YouTube and search for SAS Online, or you guys will be mailed also maybe by tomorrow EOD about the YouTube channel, and you will see that YouTube channel. You can view our videos also. Okay, so another question is, does the time decay occur from morning to the end of the day by 3:30 p.m.? Yes, you are very true here. So the time decay normally starts 9:30, 10 in the morning, and then it continues till 3:30 p.m. and then as the days move on, the time decay continues to move on. So if you guys have more queries, you can feel free to ask in your queries. We'll be more than happy to answer them. So if you have more queries, you can feel free to ask us your queries, and maybe or we'll be ending the webinar soon. Okay, so the next query is that okay, so till 3:30 is the time decay done for the next day? No, the time decay is a continuous process till the expiry 3:30, till the expiry day 3:30 p.m. Next question is, which is the best tool in technical analysis? As I already answered, a mix of moving average and RSI could be a best strategy. So as we are not getting further queries, we would like to end this webinar now. We'd like to thank everybody for attending the webinar. Thank you. You will be getting the information on the next webinar very soon on your mail IDs. So do not forget to tune into that particular webinar, and hope to get you connected very soon. Thanks everybody. Thank you.